Good morning. China has been one of the biggest stories in business, and today we're talking about the growth of China, the impact on the rest of the world, and the spate of acquisitions that we've seen, whether or not that is indicative of what's to come. Joining us on the panel, Governor Zhou Zhiqiang, the governor of the People's Bank of China, Edward Tian, Vice Chairman and Chief Executive Officer of China Netcom, Orit Gadesh, Chairman of Bain & Company, and member of the Foundation Board of the World Economic Forum, Victor Chu, Chairman and CEO of First Eastern Investment Group, Deepak Advani, Senior Vice President and Chief Marketing Officer of Lenovo Group, and Steve Roach of Morgan Stanley. Orit, why don't you begin us off, set the stage for us in terms of the perception of the situation in China from outsiders.
Well, first, good morning, and to those among you who are Chinese, Happy New Year. I believe it's a dog New Year, is that right?
Year of the dog.
The Year of the Dog. I have one, I love it. Let me just make a couple of points to Maria's question. First, broadly speaking, I think there's actually a lot of mutual benefits ahead. There's a huge new market that is opened up, or is opening up in China, a consumer new market and industrial new market. And I also think that we are seeing a formidable force really coming on the global market, which is China, which I think is going to raise everybody's game. So that's actually a very positive note in general. A little bit of context. Looking from the outside, a few years ago, most people could not name any Chinese company, or hardly any Chinese company. Today, there are actually 16 companies that are listed among the global Fortune 500. And most of them actually have investments outside of China. Excuse me. China also has announced, or at least declared its intention to have 50 global Fortune 500 by the year 2010. That kind of says that China would hope to replace 34 of the largest companies in the world in 4 years. Just as a contrast, India has 5, Russia has 3, and the 3 largest Chinese companies all would be bigger than any Indian or Russian company. In fact, the largest Chinese company would be the second one in Britain after British Petroleum. The Chinese government has actually been urging companies to acquire assets and brands and make investments outside. And as I look at it from the outside, I can see quite a number of good reasons. There is raw materials. There is the need to learn capabilities from the outside. There is the need to acquire brands, not only for to learn how to market them, but also China is, I believe, one of the largest brand-conscious countries. So the ability to bring a brand that was acquired from the outside back into China would help Chinese companies a lot. And I think also there's an issue of overcapacities, as I look at it from the outside, given the fact that different states have invested in different things. This depresses prices. Therefore, the ability to go outside and actually get assets that will bring better prices is a good reason. And they're doing it across geographies and across industries. You could see petroleum, gas, and oil in South America, in Africa, in Kazakhstan, shipping, metals, all kinds of high-tech, automotive assets in Europe, and then the more publicized ones, Lenovo of IBM, PCs, the Tempest Maytag, the Thomson acquisition by TLC, etc. So when people ask if there's a beginning of an acquisition spree, or is it just a momentarily thing, I think we're beginning to watch it. I will say one other thing, though. Up till now, China has had, I believe, a maximum of $5 billion of investment offshore of China, for China per year. And for companies, 10 million. If you want to invest more, you have to get a special regulatory disposition. So the question of who is directing actually China's investments outside is an interesting question. And obviously companies have been getting this disposition. On January 5th, Beijing announced that they are going to relax those controls. That may or may not point us towards a more of an acquisition binge, which I think raises two questions. One is how successful it will be, which many people around here can help us answer, and some of us from the outside of China may have a point of view. And the second one is, what should the rest of the world, or how should the rest of the world adjust to this Chinese momentum that we are watching, and as I said before, is welcome in many ways?
And these are the questions we are hoping to answer. Governor Zhou, as China taps into the international markets, what kind of changes have we seen from Chinese companies in terms of adhering to international standards, in terms of corporate governance, in terms of the way the company operates, versus the way the companies were operating before tapping into those international markets?
I think in China, there are different stages of so-called enterprises reform. In the 1980s, the Chinese company tried to get out of traditional centrally planned economy and become a market player. In the 1990s, many Chinese companies tried to restructure their company structure to have ownership diversification, to seeking to go public domestically or internationally, and then to learn to set up the new corporate governance. And after that, I think now the Chinese company looking more and more to the global competition. So I think that's by overseas IPO, listing overseas market, and also introducing the international investors, including fund investment into domestic capital market, and then it goes to using the common business language, including accounting standard, disclosure standard, the financial report, the OECD corporate governance principles, and I think many of such things is going forward to try to study the international best practice. I think along with this process, I think it's a good trend for Chinese company to become stronger. But to me, I think it's still some of a learning stage. It's a preliminary stage. So there is a great room for further improving corporate governance and management. And they need to join more and more global market and global competition.
Victor, can you add to that?
Yes, I think corporate governance is a process. There's always room for improvement wherever we are, whether it's in China or New York or London. And China, at least on the present state of experiment and progress, the standards already benchmarked to the international standards. And having Chinese banks going to Hong Kong and other overseas markets to subject to the vigorous scrutiny of the international listing rules, media, minority shareholders, and importing strategic investors is a very courageous move. I think China has embarked on the right step. Now, obviously, as Governor said, China capital market experiment is only 12, 13 years old. We are still at the first stage of development. So I'm very hopeful. I think I have no doubt at all in my mind that the leadership is very serious about this commitment. But obviously, China is a big country, and we have many companies, and some companies start from a relatively low base. So there will be ups and downs, but I think the general direction, we're on the right trend.
Victor, with reform and with listing of Chinese companies in international capital markets must come a critical change in the behavior and the goals of Chinese companies. They must deliver return to shareholders. And up until now, so much of the expansion in China, as dramatic and as impressive as it has been about scale. And the scale model is now being challenged, I think, on two fronts. One, the need to deliver return to shareholders. And number two, the fact that it may be going too far in skewing the growth of the Chinese economy to being supported by a rapid investment and exports. Those two sectors alone, depending upon various metrics you select for the Chinese economy, are now accounting for between 75 and 80% of Chinese GDP, and they're growing at a 30% year-on-year rate. That type of growth model is not sustainable because it leads to excess capacity and potentially deflation, or trade frictions on the export front and potentially protectionism. So China needs to redirect its own growth model more internally toward private consumption, a sector whose share of GDP has been falling steadily over the last decade. So it's terrific to congratulate China on its success over the last 25 years, and I feel very strongly that China deserves that congratulation. But the process of reform and transformation and growth is now at a very interesting and potentially very important juncture for China. And China's companies, I think, will be increasingly called on to lead that important transformation. So you can't extrapolate just on the basis of what's happened and think that's going to be the future. There's a potentially a very important turning point that is close at hand.
You're absolutely right, Steve. I think in terms of the listing of Chinese state banks, the very idea of taking them public and importing strategic investor is to make sure the fundamental change of credit culture can be executed and sustained. Now, for other listing of state-owned companies, the listing and privatization, again, is to make sure that the shareholders' return and maximize the bottom line approach will make sure that the previous bureaucracy and the planning culture is changed. So I think, they are going very much the line that you have just said. And in terms of exports, until 2005, obviously, we're talking about 30-40 billion a year. But last year was over 100 billion. But net is not that much because a lot of Chinese export obviously come from the GEs, the Dow Chemicals of the world. So again, we have to look at it from a more wider perspective. And in terms of China's growth story, I think it's very interesting that in the next 5 years, China is going to reduce the central government's budget in fixed asset investment in order to release resources to stimulate private consumption and also satisfy some of the social needs. So again, I think one is quite encouraged that the direction is right. Obviously, the jury is still out as to how they could be successful.
We have business people in the audience who may want more information on how to get real, true access to the Chinese market. So we do want to talk about that, and I think it's worth discussing a bit about Google's recent move with regard to China. But before we do, let's get specific examples of integration and the changes that you have seen, Edward, and you have seen as well, Deepak, given you were at IBM and now are at Lenovo. Edward, why don't you begin us off as far as this conversation in terms of integration in the global economy?
To me, as an entrepreneur, this question is quite practical. And I feel, in the last 20 years, China, just like a student, try to learn modern business management. And what's the best way to learn that? And I used to be a student 20 years ago. I speak no English. I have no understanding about what's going on outside the world beyond Beijing. And my approach was simple. I went to the United States. I, become a student of one of major universities. Through that experiences, I learned very quick. I learned a lot. I bring that back to China. And that experience helps me to build my own business. I think it's a very similar approach for a Chinese company going out because we are facing globalization. And China market is already a global market. We are already become the public listing company, shareholder wants good return. And how can we learn those practice? I think the best way is going out, buying to or participate global companies or participate their equities is a very effective way to learning that. And we did that about 40 months ago. As telecommunication operator, we look around us, we find Hong Kong is the most competitive market. And the 6 operators compete for that market space. And the company, most operators doing very well, responds to the competition. And how can we learn that? And the best way we find, we should participate one of Hong Kong operators' equities. So we paid about $1 billion, about 20% of PCCW, and one of leading Hong Kong fixed line operator. And now it's 14 months. I'm vice chairman of that company. We participate different kind of discussion from board level, strategic discussion, some management issues. Because we become a shareholder of that company, 2 companies become so close together. I think that we haven't faced integration issues because we want to do that step by step. Being 20% shareholder is already great learning experiences for us. Second point is also for ourselves. In the past 20 years, the common theory of Chinese corporate is we opening up our market, exchanging technology and management. So in the last 20 years, we see so many joint ventures. Basically, we give up market and exchanging technology and management. Now, a lot of cases proven, number one, not very successful. Secondly, it's very costly. Basically, you give up 50% of your equity. So current practice, we are thinking, can we become an equity holder of that company before we introduce that company to China? From a shareholder point of view, just most cheaper way, most cost-effective way to learn technology to participate in the management. So again, I agree to Governor Zhou said, it's a very early stage. We are, still a student. Probably we are only just graduated from junior high school. We have a long way to go compared to the global companies, IBM, GE, Microsoft, Toyota.
Yeah, if I could add to that, Maria, from my personal experience, what I have seen in the last year or so is, from an integration perspective, a lot of people think, well, how will the culture in China mesh with culture in Europe and United States and different country cultures? What I think is far more important than the country cultures is company cultures, which I don't think gets talked about enough. Because at IBM, we had employees in China, Japan, South America, you name it. And the ability to respect people from different cultures was always there. I would argue any multinational you go to, they have gotten used to dealing with cultural differences that are country-oriented. But from a company culture perspective, I think as you really look under the covers, Lenovo, for instance, started 20 years ago. The culture is very entrepreneurial. It is, when you look at stock options, because it's a public company, it's been for a while, stock options going to employees and executives, very performance-oriented culture. And the observations that I have is as you, and when we started coming together as a team, we had some principles. We said, look, trust, respect, compromise. That's what we have to keep in mind as we come together as one team and really put our sights on the customers that we need to serve and the competitors we need to focus on instead of, so I think this team coming together happened pretty naturally. One of the things that I see as Chinese companies go global is there's the perception right now is, the core competence that Chinese companies have in China, the comparative advantage China has is in manufacturing and scale, which is definitely a true statement. But there's a shift happening from manufactured in China to designed in China. There's a lot of design skills that China has and they're growing. And this focus on innovating in a way that is relevant to customers, at least at Lenovo, it's in the fabric of the company's culture. And so when Chinese companies go abroad, the skills that the Chinese companies will need is first and foremost a very good understanding of what the value proposition is that they will offer to customers. Is it just cost-based, or is it something else? And in Lenovo's case, it is innovation, differentiated products, coupled with efficiencies, so you're not charging a huge premium, but still selling a differentiated product. Once you have clarity of strategy, then the type of skills that the Chinese companies need to pick up are in different countries where you now do operations, having a very good understanding of what the market needs are. And that comes with local knowledge. And in Lenovo's case, they got instant access to that with the IBM acquisition. And you also need to have understanding of distribution channels in multiple countries, which again was instant access to that. And finally, the ability to build a global brand, which a lot of people say, well, what's going to happen? And I think if you look at history, if US companies, German companies, Korean, Japanese companies can have global brands, so can China. So I think having clarity of the value proposition, having clarity on what your core competence is, and then picking up the areas that you need to beef up skills in is sort of the way Lenovo is going about it.
Orit?
Just 2 points into this mix. One is people talk about this fear of what is coming, how do you compete with China? I think one thing that anybody who's dealt with Chinese companies, and you hear people saying this is only the beginning, and then other people saying, but you should be doing this and that. The Chinese culture has a very long-term way of thinking about things. And the way I like to think about what's going on in China is that it's both a startup and a turnaround. It's a startup because of all this energy and entrepreneurialism that you're seeing there. But it's a turnaround because it's a culture of 3,000 years, and the values of those cultures are still there. And so you're seeing a reinvigoration, if you will, of the culture. But it's not to westernize, it's to modernize. With a lot of our clients, when we discuss how to operate in China, the image of the, I don't even know what you call it, the smashing ping pong style that you developed, China developed really, and they dominate all the tournaments in the world, is sort of what people feel that they have to do. But ping pong is really very tactical, and it's really just looking at gaining the next point. And I think that if you want to compete effectively with Chinese companies, you have to really think about chess, because that's where every move is really oriented towards a longer-term strategic point, which is the way Chinese think. They don't think in quarters, they think in decades. And eventually I think that's going to work well for them if people understand that. To the point of what you can learn when you acquire, just very briefly 2 points. One is acquisitions are tough. Acquiring is easy. Acquiring well requires a lot of self-discipline. In Europe and the United States, and our own research, but all research shows that about 30% of acquisitions are successful. So for Chinese companies who have not done a lot of that, that is actually a tricky thing. And if I were sitting and thinking about which 50 companies in the Fortune 500 I want to be, I wouldn't look for the largest, I would look for the most profitable ones, and now we're talking strategic. But the next thing is the rest of the world looking at what the Lenovos of the world are doing, are sitting there and saying, oh my God, what do I do? And Deepak actually touched on a couple of points that I think from the other side you actually want to think about ahead of time. China is definitely ahead on the things that you mentioned in terms of cost, in terms of time to market, in terms of certain kinds of innovation. But the non-Chinese MNCs, those are pretty good, are actually ahead on quite a number of things that Chinese companies are yet to catch up. And one of the things that I believe is important is actually to aggressively invest in those areas where you still have advantage and where Chinese companies still have to catch up to sort of outperform your own self. And very briefly, I'll just mention a couple which play to what Deepak is doing. One is really insight of consumers, and that is really critical. Their cultures kind of know your consumer better than they can articulate themselves, because then you can build the right experience for the right customers in the right places, in the right countries, create loyalty, and protect your brand, which is very important. The second one you mentioned is distribution channels. Most Chinese companies are not used to multiple channels outside of the United States. They've dealt with Walmart. Non-Chinese companies have various ways of getting to market, and it's key to continue to learn how to serve them, keep enhancing your relationship with them, because that is critical, and that would be tough for Chinese companies to copy. The third one actually is innovation. And here's where I think the Chinese are doing something very interesting in many areas. I call it, you can build, you can borrow, you can buy. Koreans and Japanese basically built their companies, then they borrowed through joint ventures. Building basically was for consumption or for low cost. Then they borrowed technologies through joint ventures, which Chinese are doing, and then rarely they bought, and mostly unsuccessfully. The Chinese have sort of run right across. While they were building, they were borrowing. While they're borrowing, they're buying. Lenovo is a good example. That requires other people to innovate, to start thinking about innovation in a different way, sort of out of the walls of your company and out of the walls of your own industry. Food, pharma, cosmetics all have similar research trends right now. You can borrow from them. Nanotechnology, laser technology, biotechnology, you think it's irrelevant to your industry, rethink. P&G is thinking about those things. And finally, I think most important, everybody touched on, is the need to have strategies really globally for management, for talent, for labor, for leadership. And those strategies are going to be as important as strategies for your marketing, your supply chain, you name it, in every country, in every function, with people who have worked outside of their own country, people who come from places you might have never actually worked in. And the culture that Deepak touched on is critical, because the best MNCs have developed a performance culture that is really serves them as a competitive edge, where you can really have a distributed leadership as opposed to command and control, which is still very much Chinese. Flip that, and you can see why more Chinese companies are going to be looking to buy companies that already have those skills. And like my two colleagues here, or three colleagues, four colleagues, that's really where a lot of that is going to be learned.
Good question, though. If the strategic model for corporate China remains outward-looking, I would say then you have to look at that model in the context of much broader global trends, such as the trade frictions that are now emerging between China and the United States, China and Europe. If, in fact, the strategic model is going to start to become more balanced and be outward and inward-looking, focused on the Chinese consumer, then it may be a more sustainable model. The challenge for China, I think, is to find that balance. And Victor, you made the point, well, in this current 5-year plan, China is going to de-emphasize fixed investment and redirect some sponsorship into stimulating consumption. Will it be that easy? Is it that easy for a nation that is steeped in the heritage of central planning to stimulate and generate an internal consumer culture? China has been terrific at mobilizing resources into the fixed investment and in the externally oriented export production area. But consumer cultures are special. They require job security, income security, safety nets. China's making attempts in all of these areas, but it could be a very challenging and long-tail development. In the meantime, if corporate China purely has this outward-looking strategic model, then the response of the rest of the world becomes critically important in establishing the metrics for success in corporate China. And I certainly don't doubt China's vision and commitment, but the feedback from the rest of the world is very important in that regard.
And we're going to open it up to questions in just a minute. So if you have questions, please do think of that. But Governor Zhou, please.
I would like to respond a little bit on all it said and Stephen. I think development strategy is also related to the cultural background of China. Chinese government already identified the internal demand-driven development strategy. We would like to expand the domestic consumption, especially in households consumption. And we emphasize that our service sector now is still relatively weak, so there is a great room for further development. But however, talking about the export sector and overseas investment, it's related to the saving rate. In China, now the saving rate is a little bit over 40% of our GDP. We know it's related to the culture, to the structure of society, to the value of a family and the others. Nobody can really interpreting why the saving rate is high. But many people know that it's not only China, but many other Asian nations also have a relatively high saving rate. So having saving rate, that means you have a relatively less percentage of household consumption. So the producer have more pressure to export their goods to the other country. And it also have an impact to the merger acquisition. So because of production integration, because of scale effect, the company need to get together. But it's depend on whether do you have money or you only have a labor. That's how much is your stock price to facilitate the merger acquisition. So I think it's in this regard also impact to the pattern of global merger acquisition. But for China, I think there are several interpretations of why saving rate is high. One is call back to the Confucius tradition. Another is that China now is undertake several reforms related to the safety net, as Stephen mentioned. That's the pension reform, medical reform, education system. This is a transitional period that the population do not feel good enough certainty for spend monies for the further consumptions. So they may have periodically intention to save higher than what they should do. So the opinion is that China should accelerate the reform in pension system, in medical system, education system, and the others to reduce so-called precautionary saving and to let the saving rate down a little bit to the normal percentage of our GDP. So I think it's to some extent can solve some of contradictions in what we talked.
Just a quick question, and then if China cuts back its saving, that's going to make it very hard for America because we count on Chinese to save, to buy our treasuries, to support our economy. What are the implications of that?
It's, up to now, some of Chinese saving goes through the foreign exchange reserve is buying some of U.S. bonds, treasury bond, and the others. So I think this is a globalization. So saving can move from this country to the other country. In the 1980s, a lot of foreign savings go to China in form of FDI. But now it's also some amount of Chinese saving go into the other country. So I think basically this is a part of globalization. But we need to pay attention whether this is a healthy trend or not, whether the current situation is stable, sustainable or not. If not, we need to make changes to get a more balanced situation.
Let me ask you to address the issue of foreigners getting more access to China. First off, Steve, what are your thoughts on Google censoring itself to get access to China? Is that what it takes? I mean, there are certain industries, obviously, that are much more open than others, and I do want to get your thoughts, sir, Governor Zhou, on financial services in particular. But first, Steve, on Google.
Maria, I don't have a specific comment on Google per se, but I think it's reflective of a clear trend that most countries have in place today, and that is for non-local entities to operate in domestic markets. They have to tailor make and customize their operating procedures to local conditions. The Google issue is very sensitive because it does involve some information censorship issues, and I don't really have the expertise to comment on the specifics of that. But it is not unique for European countries, the United States, or Japan to impose regulatory strictures on non-domestic companies to operate in their markets.
Edward?
I think, we frankly have been in telecom internet world in China for the last 10 years. Internet is very, very new things for China. And think about that, this country has been, isolated from the rest of the world in the last few thousand years, and now it's internet stage. So all people have to learn, particularly regulator, how to deal with this. Google, search engine, tech, Web 2.0, all those new things, I think it's hard to understand even for people in this field. I think we should give some certain time for Chinese regulator to figure out, to learn. Internet is very, very important for China, and the internet is a new technology like a steam engine of the 21st century is critical for China modernize itself. So I think it's still right now in the very early stage.
That's a really good point.
In China, I think many Chinese people is good at mathematics. So they always try to optimize some things to see this, the sequencing of reform and the sequencing of open door policy, gradual opening up in this sector and then the other sectors. They also learn a lot of experience happened in Japan, Korea, how to deal with the sector open policy. But however, sometimes people are very easy to miscalculate that. So that means that you try to protect the infant industry and to let them sort of grow up. And at a certain stage, you have a more open door policy. There is no clear evidence that this kind of sequencing of strategy are highly successful. Different people may talk a different story. Too much protection may protect the negative sides. Generally speaking, I think since China entered the WTO in 2004, and we also arranged a 5 years transitions, and after that, that is this year's December, and the government gestures in this policy are very clear. Like our Vice Premier Zheng Peiyan yesterday said that we are encourage the country in every sector to have a more open policy. We benefit a lot from open policy. We will continue to go into this direction.
And this is no different from actually what most multinational companies have had to deal. There are many non-Chinese multinational companies who've operated in 120 countries, sorry, and had to adjust to the way business is done and the culture in each country. Mm-hmm. And there are quite a number of companies who've been in China now for 20, 25 years, learned how Chinese do business. And in fact, Cisco, for example, yesterday I was talking to John. They've been there for 20 years, and they now own 100% the company. And they have worked with the government to figure out a way for them to work so it's good for them and good for China. That's no different from places in Africa. It's no different from somebody coming to the United States and having to adjust to United States regulations, right, or German regulations about whether you can fire people or not.
It goes both ways,
yeah,
as far as the education. Let's open it up to questions from the audience, if anyone has thoughts. Yes, sir.
Thank you, Fred Kemp from the Wall Street Journal. I wonder if you could drill down a little bit more on the second question in the program, which is the international acquisitions question, and whether we're going to see a binge or at least a trend going more in that direction. And there I have two questions. First of it is how much government influence and what sort of government influence is there on this acquisition trend? And second of all, looking at the United States, we know all about the CNOOC story. The U.S. is obviously a very interesting acquisition market. What does one have to weigh there? And could one see, for example, in a non-strategic area like Walmart, that the Chinese could make an acquisition? A Chinese Walmart, for example.
Good question. Who would like to take that?
Well, I can take the second part of the question as far as what will Chinese companies sort of look for? Because one of the things that we talked about is the strategic planning and long-term strategic thinking. That is very much true. And I would also add, Uri, that also coupled with that is very, very disciplined execution. That's a common trait that I have seen. But in the instance of Lenovo, IBM, one of the things we looked at is, does this deal make sense from a classic synergies perspective, right? So in this instance, when you looked at the skills that Lenovo in China had, and what the IBM PC division offered was a really, really good fit. They were very strong in consumers and small business. The IBM PC business was very strong in large enterprise mid-market. They were strong in desktops. IBM was strong in notebook. So overall, and there was hardly any channel conflict outside of China. So the synergies were very, very strong. And then you layer on top of that the commonality in values and culture, which really is based on, innovating is how you differentiate in the marketplace, and also a lot of focus on meritocracy inside the company and very customer focused. So as long as you have that common cultural values between the two organizations and you have very good synergies on the business areas, it makes a lot of sense. And that's what, that's what drove this particular deal.
We have about 10 minutes. Reed, can you tackle the question of whether or not this is a trend in terms of Chinese acquisitions?
I think you're watching it. I don't think there's any question. First, why wouldn't a Chinese company do what the rest of the world is trying to do? They definitely have the resources right now. They have a huge amount of money that they can spend. And as I mentioned before, there's going to be a lot more flexibility in what they can do. They have real needs, which are absolutely real. First, they want to compete on a global basis. If GE wants to be in China, why can't China, comparable to GE, want to be in the United States? The second thing is they really do need to go outside. They have been. And in fact, if you read carefully, the Chinese government has been trying to suggest a little less noise about it so that we don't see the backlash that we saw in the United States, which is just bad timing and political issues as well. But, for example, we mentioned the brands before. There are very few Chinese brands that are recognized outside of China. Since they're so brand conscious, if you look at what luxury goods is doing, for example, in China, foreign luxury goods, it's unbelievable when they can actually go and buy something that is much cheaper and looks exactly the same. They're very brand conscious. So if I want to buy Gucci, for example, and own it, I would have a huge market eventually in China as the middle class grows with brands that are already well recognized. Management skills we talked about before, it's absolutely critical. That's why Edward bought 20% of a Hong Kong company. That was its stated objective. How else are you going to learn it? How are you going to compete? Talent is going to be one of the most important things that you're going to be, there's going to be a battle for talent. That's why I talked about literally having strategies for that. China needs to be able to work with multinationals, multicultures. All of that is going to come through two things. One is companies coming to China and joint venturing, but more importantly for them, going outside and venturing there and learning how to deal with not just Walmart, but all those different challenges, all those different consumers, how to localize things, no different than what P&G is doing when it's localizing to China. So it's a must, it's happening, there's a lot of money, and it will go on. The question you will ask is just how many of them are going to be successful, but that's a question you can ask about US companies, German companies, French companies, and you can go on.
So briefly, which industries would you expect to see targeted the most in terms of, I mean, we know the demand as far as raw materials. Is it fair to say that is where we will see the majority of acquisitions?
High tech, technology, that would be my guess, and for good reason.
But wait a second. I mean, isn't that easy just to say that that this is part of China's strategy to go global, to compensate for domestic shortfalls in strategic materials or technology? I don't think you can just dismiss the CNOC Unocal issue as one of timing. The outward-looking acquisition strategy of corporate China has to be seen in a broader context of how the rest of the world is dealing and coping with China. We may not like it, and as economists we may abhor it, but there is a growing political backlash to the globalization of these labor arbitrages that are holding down real wages and employment growth in the wealthy, developed world. And that sets the stage for politicians to intervene when the Chinese want to acquire, at least in this case, what was viewed as an important U.S. asset. I don't think the rejection of the CNOC Unocal transaction was just a one-off thing. It's emblematic of a broader global issue that the Chinese must address, that the United States must address, the European politicians must address as well, and that is trying to get a better sense of comfort about the broader picture in which we are attempting to integrate the global economy. And I think a lot of progress needs to be made in that regard.
Let's go
I think
ahead.
that's true, but you see a lot in South America. China has done a great job of bilateral agreements surrounding the United States, if you will. Russia, yesterday Saudi Arabia, although it's not an acquisition, Latin America, all over the place. So there are a lot of other places. You're absolutely right about what you said about US and Europe, and those are things that still to be negotiated.
We only have 2 minutes. Let's slip in one more question. Yes, sir.
Thank you. Chris Giles from the Financial Times. Governor Zhao, you were talking about speeding up reforms to reduce precautionary saving in China and increase domestic demand. The corollary of that would be a reduction in the growth of foreign exchange reserves of the country. Can you just expand a bit more and tell us how quickly you might expect the $200 billion a year rate of foreign exchange reserves to slow down?
China, I think government already expressed there is no intention to have a faster accumulation of foreign exchange reserve. However, in the recent years, after the Asia financial crisis, there was a need to recover from the crisis for many Asian countries, try to build up the stronger export sectors to accumulate to some extent the foreign exchange reserve. So I think in the beginning of this century, this is a rational trend for Asia economy to go out of Asia financial crisis and to prepare second or third similar crisis. For China, I think foreign exchange reserve came mainly from three sources. One is the trade surplus. Since we have a certain kind of trade surplus, so we can get some of a source of foreign exchange reserve. Another is capital inflow, including foreign direct investment, including Chinese external debt, and including those of Chinese company go overseas to have an IPO. These all bring the foreign exchange into China. The third one is that the service trade and the money relationship among Chinese citizens and overseas Chinese companies. There is also some of remittance monies back to China. In China, we always allow domestic citizens and domestic enterprises to maintain foreign exchange account in the commercial bank, so they can utilize their foreign exchange account and the domestic currency account. They can try to make a decision as which one should be more. But I think because the government already initiated to strengthen the internal demand, especially the consumption demand, and accelerate the service sector development, it needs a lot of money domestically. As Vice Premier Zeng yesterday said, that we are building a much better rural area. It's also need a huge amount of money. And then stronger domestic demand to some extent must reduce trade surplus. And also to channel the high saving into domestic use. So all this policy, plus the exchange rates, the new regimes, and the development strategy realized by many of Chinese companies, we believe that the foreign exchange, the pace of accumulating foreign exchange reserve will be reduced.
That's obviously a very, very important point. And to recap the other questions that we talked about this morning, it appears we are in the early stages as far as integration and really understanding not only the Chinese market, but the Chinese understanding other markets and opportunities, like you said, Edward, the internet. We are really in the early stages. As far as deals are concerned, you all seem to agree that we are in the early stages there as well, and we'll see more deals. But of course, Steve, you mentioned that we will that the CNUC-Unocal situation may very well not be a one-off thing, and that needs to be addressed. And Arit, thank you for your prediction on high tech. Thank you for being here.